Bear put spreads. A bear put spread is made up of only put options. You buy a put with one strike price and write or sell another put with the same underlying stock and expiration month, but a lower strike price. The position is a debit spread because the long put will always cost more than the cash you'll receive for the short put. You'll always pay a net debit to establish it. Here's an example. Buy one XYZ June 50 put at $6. Sell one XYZ June 45 put at $4. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.